Hi, friends. It's a bright new day, right? So let's make good use of the time we have at our disposal. So we're wrapping up the taxation, the second part of the taxation, the deferred tax. We'll look at elements of revaluation gain and the corresponding tax that will be associated with it as the second part of this presentation. Once again, there's nothing complicated. Same taxation that you know. So if my tax liability will increase, what do I do? Okay. Of course, I'll have to recognize it in my income tax. In my income tax schedule, we normally prepare a tax schedule independently from our financial statement. We post the final element there. So what we are saying is, if I'm anticipating that I'm going to incur some tax, the same principle we know in dealing with corporate taxation. The same thing. Increase your tax expense in your statement of profit and loss, and correspondingly recognize your tax liability. Okay. All right. So we move on. Keep picking up from where we left off. I'll share my slide. Okay. Then we can see what we have. All right. Okay. So this is what I have. I'll run through quickly. I think we've done up to a certain level where we recognize it. So I'm just gonna quickly skim through. So we look at the two elements. We look at calculating the temporary differences, the accounting entries for a current tax, purpose of a deferred tax, okay. And then we're looking at the accounting entries, like I said, post them, charge it to your profit and loss account as a tax expense and credit your tax liability, okay. And then when there's a temporary difference arising from your carrying amount of the asset and then the tax base, what do you do? Okay. But if there's no temporary difference, no impact on deferred tax. But we took an example where we typically saw the carrying amount exceeding the carrying amount exceeding our tax base. Let me connect this. Exceeding our tax base, and we use that as a platform for calculating our tax liability. We did not touch much on deferred tax asset. We're more interested in the tax liability. Okay. All right. So we did this example and we ran through these calculations, and where the tax liability increases, we credit the deferred tax, debit the income tax expense. But when we subsequently did the adjustment and realized that the tax liability needs to be adjusted downwards, we credited the income tax expense and then we debited the deferred tax liability to increase it. Okay. And then we said, in terms of recognition, we should recognize them in terms of the temporary differences arising. Okay. And of course, if you should have any tax assets where we are finding we're getting a deductible temporary differences, we need to also recognize them. And so far as our profits are concerned, okay, utilize these deductible differences. Now let's move on. Measurement of tax liability. Same old principle applies, nothing complicated. We said in terms of identifying the deferred tax balance to recognize on our books, we multiply it by the tax rates in circulation currently in force, or which we expect to be in force in the accounting year in which we are operating. Okay. In which case then we'll recognize our tax liability, or if it's a tax asset we think we'll recognize, we need to recognize it. Some jurisdictions may sometimes adjust the corporate tax rate downwards, in which case you get some relief. Okay. Some even go for tax-free, should I say a subsidy or some form of tax holiday, just to improve, to give the companies some relief so that they can operate more, produce more, hire more staff. It happens in most jurisdictions. We're not looking at that concept of taxation in terms of the theoretical elements. Let's look at just the financial reporting component. So whenever there is a tax increase, yes, there's an increase in the tax liability. As usual, we debit our income statement, okay, the statement of profit and loss, with a tax expense and credit the deferred tax. But when there's a decrease, we have looked at this in the previous example, in the first video. Then we'll debit the deferred tax and credit the tax expense, okay, so that we'll get this reduction. But the question is, What if the deferred tax, okay, the item which gave rise to the deferred tax was recorded in OCI, other comprehensive income? Let's say we undertook a land revaluation of a property, plant, and equipment, and then we actually had recognized this gain, the revaluation gain, in other comprehensive income. Okay, so for example, PP is revalued, okay, PPE is revalued, and when we revalued it, we got a gain, okay, we got a gain. Now, this gain, ideally, what do? We have to debit our PPE with a gain. Is that not it? Right? And then the corresponding, the credit, the revaluation gain. Where did we capture it? The revaluation gain, where did we capture it? If we captured it in OCI, then the corresponding tax component must also be knocked off against this revaluation gain in the OCI, other comprehensive income. That's all we are saying. Nothing complicated. Let's take this example. So King Company Limited has the following items. Okay. So deferred tax has a credit 17,000. Then within the same period, they have a tax expense they have to recognize in statement of profit and loss of 2,200. Okay. The directors have estimated that within this current year, the tax we are going to be paying is 26,000. Extra tax they think they will pay. They've estimated. Okay. So these are all provisions. Okay. The next topic we look at IAS 37. We'll take a good look at provisions. Okay. Contingent liabilities, contingent asset. What is the meaning of provisions? Okay. Those streams of uncertain amounts which we always estimate. Okay. We'll look at that. Okay. So here we are estimating that we will be paying 26. So it may not be the same. It could be higher. It could be lower depending on the profit we report. Okay. Now, the difference between the carrying amount and the lower tax base is estimated to be 63 on King's net assets. The tax rate is 30. So there's a temporary difference arising. We'll surely know that our deferred tax will be our 30% of this temporary difference, right? Of the temporary difference. We have recognized, okay, of 63,000. Good enough, they've calculated it for us, right? They're telling us that current amount exceeding lower tax base is 63. So do this calculation and what do you get? And compare to the current tax, deferred tax component. And ask yourself, did it increase? If it increases, what do? You all equally adjust this, right? But if it decreases, what do? You all equally adjust this downwards. And the corresponding effect will also apply to our tax expense in the statement of profit and loss. Nothing complicated. Is that it? You see? But this 26,000, ideally, this is the extra tax, so we'll have to recognize it as this. Add it to the 2,200 to get our tax expense. Let's work and see. So threefold impact, okay, that will normally arise. One, we have to transfer the figures on the trial balance to the pro forma calculations. Okay, so here we will debit the debit balance on our taxation will form part of our profit and loss tax expense for the year, and the deferred tax will form part under of our non-current liabilities under the statement of financial position. Okay, so these two items, which we already know is a non-current liability, right? Hopefully, we are assuming that it spans over more than 1 year. And this within our statement of what profit and loss, we charge it. So let's transfer this to our pro forma and then adjust these figures which are coming up. Okay, that's the first point. The second thing, the figures we've been given in the numbers, the 30%, the 63,000 temporary difference. Okay, let's use, and the 26,000, let's use these figures to adjust our current year taxation in terms of increasing our tax expense. So the 26,000, okay, against our 2,200, okay, to give us our total tax expense, okay, which we will recognize, okay. And then we could also create a liability correspondingly once you are making a provision of 26. There are two legs, accounting, double entry. Or if you debit P&L, Where would the credit go? Create a tax liability, okay? Now we have to calculate the deferred tax, okay, which we said the tax rate of kin is 30 times the temporary difference of 63, okay? And then we compare it to the 17,000 deferred tax brought forward, okay? The deferred tax 17,000 brought forward. We compare and check, did it go up or did it go down? And then after that, we will then adjust accordingly. Okay, so the 30% of the 63 gives us 18,900. But that is 17,000. So the 18,900 means it has gone up against our 17,000. It means there's an increase of what? 1,900. Is that not it? Simple calculations, right? This is what happens in terms of point number 3. Simply, we are going to then increase our deferred tax to 18,900. But the extra 1,900, where would you post it? It's an increase. It's an increase in our tax expense. So of course you need to add it to the tax expense. Initially, we would have thought that it would just be 26,000 provision for the current year plus the 2,200, assuming we have not paid. This is balance brought forward. Let's say so. Okay, this is the current year. Okay, current year tax. But we are getting an extra 1,900. So we need to add the 1,900. So that at least we know that we've created a provision and the corresponding must be recognized within our books. Okay. So this 1,900 should be added to the total tax expense. So the 2,200 in our trial balance plus the 26 we have estimated plus the extra 1,900 which we have calculated from the deferred tax. So our total tax expense becomes 3,100. Okay, 3,100. That's it. Okay. Now, our deferred tax has increased. So you know why we got the 18,900. So our 30% of the temporary difference. But we then have to create. Remember, this 1,900 is within this. This 2,200 is on the P&L, of course. But the 26, which we have created, estimated for this year, should now be captured as our current liability in terms of taxation. Double entry, simple. Okay, now let's move on and look out for revaluation. Like we said, when there's a revaluation gain which has been captured under other comprehensive income, what do we do? Okay, what do we do? So deferred tax should be recognized on asset revaluation as well. Revalue your assets, and if there is even no intention to sell or dispose of the asset, still recognize your deferred tax. Okay, so if the revaluation goes down, it's a deferred tax asset. If it goes up, it's a deferred tax liability. Okay. Now, revaluation gains are recorded in other comprehensive income, usually, yes. So any deferred tax arising should also be recorded in the other comprehensive income. Okay. Now, the effect is that it will reduce the gain we have recognized on the revaluation to get a net tax amount, to get a net amount, an amount net of tax. Let me put it that. So let's always recognize the tax component. Okay. All right. So for example, Shinji on 31st December revalued its land and got a gain of 60,000, tax rate 30%. So usually once there is a gain, what will happen is that we debit our land, right, with a gain of 60,000. Then the corresponding credit, we may have recorded it under other comprehensive income as revaluation gain, right? As revaluation gain of 60,000. But this gain, we need to recognize the tax component on it. Okay, so we will have our 30% of this 60,000. Okay, and once we get our 18,000, we can easily knock it against this same revaluation gain in our other comprehensive income. Okay, let's work and see. Okay, so like I said, this again, we might have recorded it this way. We calculated our tax component, 18,000, and we must again knock it off within other comprehensive income. So you debit other comprehensive income and you recognize the credit leg in deferred tax liability. What will this show on the face of the financial statement extract? Let's try and see. So simply, our PPE, the PPE will be whatever value of the land plus the gain and the non-current assets. Okay. But in our other comprehensive income is the 60 minus the 18. So 42 must be recognized. Okay. This 42 would then have to be transferred to revaluation reserve. Okay. Or anyhow we try to term it. Is it maybe revaluation surplus, anything. So and the equity component, the 42 then goes to revaluation surplus revaluation reserve. Subsequently, when you had revalued it and it has dropped, the value of the land or property has dropped. After you've done all your calculations or and your postings, you go back and adjust this again downwards, not upwards. Okay. So the corresponding leg, we have debited our other comprehensive income with the 18. The credit leg goes to non-current liabilities, deferred taxation. Okay. Any changes that happen in terms of this revaluation must always be working between our gain or loss on revaluation against our revaluation reserve or surplus and against our deferred taxation. It's the same as charging it to the income statement or statement of profit and loss. It's just a matter of arranging them at the correct and under the appropriate heading. That's all I'm saying. Okay. So we end here. Okay. Chapter 13 of the study text gives us a detailed explanation of these that we've looked at. Okay. So please take a look at that. So I'll ask you to read the chapter 13 of the financial reporting text by Kaplan. We use these questions for our tutorials, nothing more coming from anywhere. So you find this online and then we will work it through. Okay. We'll be using this for our tutorial. So no worries. All these questions and we'll treat them in class. For now, friends, I bring it to a close. And what I'll say is that practice as usual, more questions. And you'll be fine. What we're doing here is that at the end of the day, any concept we teach you, we want you to go out into the field of work, either in academia, either in practice or industry, or setting up your own business, so that you can articulate these points, these standards, at least to 70%. At least you meet your peers and you can articulate 70% of the core concepts and let them know that you are the master of your own affairs. I'll see you, friends. Bye for now.